This week in life insurance, we're coming to you from Mexico City once again. We are at our morning coffee shop waiting for our coffees here at Habano and Roma Sur. And this week, people are talking about client servicing. And there's a couple of different things happening that are kind of coming together in an interesting way. So on one side of the ledger, you have carriers who are kind of leaning down their staffs, kind of cutting overhead, and also losing a generation of talent. And that means that they're not as well equipped or able or capable to provide kind of that client servicing post-policy issuance that we've seen in the past. What that means is that a lot of that work now falls on the shoulders of the producer. At the same time, we're seeing a lot more of kind of more advanced products being sold. Things like IUL, VUL, and PPLI, which we'll get to in a second. But with that kind of higher level of product, you're having a wealthier client who's used to a certain level of service that they're getting from their money managers, their estate lawyers, their accountants, that insurance producers now need to match. However, the compensation model for kind of traditional life insurance products is obviously a huge commission up front, and there's no kind of ongoing trail to incentivize that kind of servicing. Which leads to the question of, do we need to start talking about changing the way we compensate life insurance producers to more of a PPLI model, where rather than an upfront keeps commission, you kind of get an annual payment based on the size of the policy. And now this would not only help incentivize kind of ongoing servicing of those policies, but also make these producers more attractive potential acquirers because they would have a known level of revenue that they're getting every year rather than starting from zero every January 1st. It's an interesting question that keeps popping up more and more, and we'll see what happens. That's all for this week. We'll talk to you soon.